Hey there, it's Mike Wise over at Capstone Direct, and some exciting stuff here is we're talking about why there are no point loan options out there at this point in time with these high interest rates. So let's talk about what's a point. Well, 1 point is 1% of the loan amount. So normally when we're quoting interest rates, we do a 0-point loan. It doesn't cost anybody anything at this point in time. Right now, what we're doing is we're saying it's costing 1% or 2% or what we call points. 1% is 1 point, 2% is 2 points. That is 1% of the loan amount. So a $100,000 loan is $1,000 that we would be charging for 1 point. If it was 2 points on a $100,000 loan, we would be charging $2,000. But let me tell you a little bit more. I'm going to break down. The interest rates are actually made up of two different factors, and I'm going to tell you why we're charging these points right now. So interest rates are made up of bond prices and the yield on the 10-year Treasury. So as the yield goes up, interest rates start to go up, bond prices start to come down. That's just normal. We see that every single day. We talk about it a lot. That's one piece of the pie. The second piece of the pie is the servicing values. So a servicer is actually going to pay me in a normal market 1.5% to 2% for that loan, to service that loan. They get the rights to service that loan. They buy that and they give me 1.5% or 2% points on that particular loan. In today's market, which we've been talking about for the last couple of months, is that we think interest rates are going to come down. Well, so do the servicers. So much so that when they pay 1.5% to 2%, they're expecting that loan stays on their books for 5 years. So they start making money after 5 years. Well, in today's market, with today's interest rates at 6 3/4 or even 7%, that's where they say, you know what, that loan is actually going to pay off in 6 to 9 months because we think interest rates are going to come down and the borrower is going to refinance their loan. We're going to lose money on that loan if we actually pay 1.5% to 2%. So instead of them paying 1.5% to 2%, they pay me 0.25% or they pay me nothing, right? And so the trickle-down effect of them only paying either nothing or 0.25% is the consumer actually gets charged the points. And so that's where these 1 to 2 points come into play, and the consumer has to pay those. Or in some of our seller-paid options, we get the seller to help pay for some of those points. Hopefully that made a lot of sense to you. And if you have any other questions, you can follow me on Instagram or on YouTube. We've got a lot of videos explaining these types of things to you in more detail. Or you can give me a call and I can explain it in detail to you over the phone.